Hello, it is Evan here from the Trade Risk, and this is your stock market weekly update for Friday, October 6, 2023. Big story this week was yields out there, mostly on the sort of mid duration, so talking 10 years plus, really accelerating higher this week, breaking out to new cycle highs, something we've been talking about tracking for many months now, or really probably a year plus, as sort of the risk factor here in terms of stocks and the pressure it puts on stocks. Really seeing that kind of acceleration this week, which begs the question, are we starting to get to some capitulation levels here for looking specifically, say, at TLT bondholders? I think that's like a 50% drawdown now. Don't quote me exactly. We can look at the charts in just a little bit. But I mean, just seeing some massive pain, big volume there, lots of turnover. And so it just begs the question of some type of at least short-term capitulation here, which we'll look at the charts in just a moment. The good news is, of course, for you dividend investors or fixed income investors, retirees, you can now lock in 5% for a 25 plus year duration. So if you are someone that is looking to lock in those current interest rates, current yields, 5% now, that's about it. Or you can get a little bit higher maybe depending on the duration. But it's impressive. I mean, it is the highest yields that we have seen in quite some time, 2006 or before. Oil, also big story this week, of course, getting a violent pullback. So oil has been basically, one of the best places to be in commodity land or outside of stocks over the past handful of months. Oil has just continued to perform to the upside until this week, where we finally got a bit of a violent sort of pullback here. We're going to look at those charts in just a little bit. Technology, once again, the outperformer. So last week it held the line. It was that relative outperformer last week. It didn't really gain any ground last week, but it didn't continue to sell off like many areas of the market. This week led the charge back to the upside. We're going to talk about that. And we did get a brief spike over 20 there for the VIX. It was brief because we are below it heading into Monday. So all of this and more, stay tuned. All right, we're back here. We've got some charts in front of us. We're using Warden TC2000. So for you Warden TC2000 users out there, check out our website for a lot more indicators, scans, custom coding, anything you need built for the platform. Let us know. Reach out to us at thetraderisk.com. For those of you who are looking at a new charting platform, check them out. We got a referral code for them. Might get you some discounts. And we do service the platform with lots of add-ons for it. So check us out at thetraderisk.com. Let's get into the numbers here. Right-hand side, you can see 1 week returns. Dow Jones did close negative. Russell 2000 did close negative. And then look at the S&P and Nasdaq. So you really have this tale of two markets here this week, depending on where you were invested, where your money was. You had definitely a different outcome this week. A big spread, almost 400 basis points between Nasdaq performance and Russell performance. Almost 2% up for Nasdaq, almost 2% down for Russell. You can see on the 1 month returns, again, you can see the disparity here as well. Russell 2000 certainly underperforming over the past 1 month. Now, if we take a look at volatility this week, you can see pretty much unchanged, and it doesn't really tell the whole story because we did have a lot of action this week in between. We had some pretty violent price action, and mostly Friday was the big sort of recovery rally here, or the big ramp up in equity prices mostly occurred at the end of the week on Friday. But there was a lot of turbulence to start the week, middle of the week. Ultimately, though, Nasdaq vol close settled in right around over 21.46. VIX S&P vol index here 17.45 was down just a smidge. You can see on these line charts here, these are the 5 days. So it's just a week return, the path that the stock market took in each of the major US indices this week. And you can see again, kind of slid down to start, chopped around, and then rallied into Friday into the weekend. Let's take a look at sectors here. You can see, again, very, very sort of polarized market here. Technology, top of the stack, 2.62% upside. Communication services, kind of more of the same. And then you did have healthcare up almost 1% as well. I think there was some M&A. There's some decent activity happening in that space. But you can see only bright spots here were in these three sectors. Everything else was a loser, some by just a little bit. But on the downside, energy was getting hit the hardest here, down 5%. Staples down 3%. Lots of really painful charts there in staples, and then utilities also down 3% tied to the interest rates story. And you can see on the 1 month returns, again, lots of sharply negative sectors here, but you're starting to get communication services, healthcare, tech acting a little bit better after the back-to-back weekly return performance. If we move on over to the trends here of our sector outlook, you can see again, just mostly still in bearish positioning across the board. You are starting to get a couple of sectors trying to turn up here. So technology, even despite the back-to-back relative strength that we just talked about, you can see that on its daily chart, it is finally starting to just turn right back up. These are our custom smart trend filters that look back over price and volume spanning across time, few price action relationship rules, but it really just helps measure path of least resistance, kind of green, red, or yellow dots, depending on who's in control here. And basically, again, when you look at this picture at a glance, you can see not a very rosy sight here for markets, despite that bounce back on Friday. If we take a look here at market breadth and we get a little bit under the hood, you know, we've had a pretty good washout at this point. So, you know, when folks are talking about the stock market correction and you know, there's more pain to come and the bears are getting really excited, it's worth taking a step back and taking a look at some of these measures that we do look at every day. And we'll start here actually in the percentage of stocks in the NYSE that are over a 50 SMA. And so if we just zoom out on this chart here, I'm going to collapse everything else just so you can get a nice clean picture. And I know it's a little bit noisy. See if I can clean that up. So take a look at this. And so basically here you can see that we got as low as 10.77. So only 10% of stocks in the NYSE are trading above their 50 SMA. And if we look all the way back, as far as I can go, at least here, I mean, it only gets us about 5-6 years of data back to 2018. I mean, kind of the best corrections or washouts are when this, you know, ratio gets down to about 10 or 11% or so. And so we are at extreme readings, even though it may not feel it entirely, because you do still have kind of the big heavyweight mega caps, Magnificent Seven, or whatever you want to call them. They're still, you know, acting pretty well, all things considered, for these market cap weighted indices. But as soon as you go outside of those stocks, there has been a lot of pain out there. So putting this pullback into correction, this is just one chart that you can use. Of course, you could look at the percentage of stocks over 200 SMA, and we're not at quite the same extreme levels of washout here on the 200 SMA, but we're certainly in the lower percentile here with only about 26% of stocks earlier this week above their 200 SMA. And then, of course, we look at our 52-week highs and lows ratio. We did get, again, a good spike here last week, and recently had a couple of days here in the 500, 600, 700 range, zooming back to the big kind of sell-off days, the bear market of 2022 when things were quite brutal, and even COVID. You know, we had days where thousands of stocks were making 52-week lows. So we certainly didn't see some type of epic, you know, multi-month, multi-year sort of washout, but we did get, again, the biggest washout, I'd say, this year, of course, right? And the data is supporting that as we look across all these different metrics. So there are lots of ways people can use to measure kind of the broad market health. There's all different ratios, all different look back periods, right? So I don't want to try and cherry pick or hang too much weight on these specific, but I think if you look at RSI or, you know, any of these other measures, you're basically going to come away with the same thing: is things got pretty oversold. And so we are starting to perhaps rebound a little bit now, and there are perhaps some opportunities out there, and we're going to talk more about that when we get into some of the charts. You can see, of course, you know, we're looking at percentage of stocks up this week. Those ratios still not that exciting over despite the rebound on Friday, thanks mostly to the Russell, Dow, some of those other components that were outside tech. We're still, you know, again, feeling some pain this week. If we take a look here at IBD's list, so shout out to IBD. Take a moment here. They are a sponsor of the show. They help make the show possible. So you can get a link in the description of this video, get you access to their digital subscription. And this is where I'm pulling the top 10 10 stocks in their IBD 50. You can see this week pretty positive, but again, a fairly split week as well. Lots of things here. So ACM Research, I believe this is their number one IBD number one stock right now, followed by LPG. You can see these all up nicely, but we did have a little bit of pain here in, so for instance, this Goosehead Insurance, GSHD, down 6%, and so on and so forth. So check out the link in the description, get access to IBD Digital, along with lots of other fun stuff. Moving on to commodities here. So big story. Besides crude oil, actually, and I didn't list this in the top 5 things we were talking about at the top of the show, but it was natural gas. Natural gas breakout. We're going to talk about the chart. We're going to look at the chart in just a little bit, but finally starting to get going. Nice, beautiful base there. It's been, grinding sideways, doing lots of head fakes. Had a big move this week, up 13%. DBA, dollar, still another up week for the dollar. There's a good tail on the top end here, but still just more and more strength out of that, out of the dollar index. And everything else was pretty much red. So gold continuing with pain, copper continues to break down, silver more pain, and oil was down 8.29%. That's a big week. It turned the 1 month returns negative, and of course still in, I guess it depends on how you define it, still an overall uptrend, but certainly seeing some pain there for most commodities. Big story again, as we talked about, were yields. So mostly on, again, that 10-year plus duration. The inverted 10s 2s, which everybody looks at that 10s 2s ratio when things are greatly negative there, kind of, sort of suggests or comes at points preceding a recession. That ratio is actually starting to shrink. So we're getting less inverted in the 10s 2s yield curve. And it's happening, though, in an unusual way, because it's the 10-year yield that's really sort of blowing out to the upside, while some of those short-term interest rates remain, kind of mostly the same or slightly higher. So again, you can see on these charts here, if you look on the right-hand side, 10-year yield index here in TC2000 breaking out to new cycle highs. Same thing with the 30-year breaking out to new cycle highs here, as we get the MOVE index moving back up into the 130s, which is basically the VIX for fixed income. So, again, lots of pain here, lots of pressure, and certainly the story of the week, which we talked about at the top of the show. So let's get into some of the charts here that we think are pretty important here. We'll start it off with the S&P 500, as we always do. Here's our trusty roadmap, levels that have been on the chart for quite some time. And last week and the weeks before, we've been talking about this 4280 to 4300 zone here. This has been a price level that the market has cared about. There's been lots of reactions, inflection points, and price memory at this level going back over the past year or two. And you can see after 2 weeks of a lot of volatility, lots of tails, we were trading underneath it definitively. But if you're looking at this on a weekly chart and sort of cleaning up the noise here, you can see that the bulls are putting in a really good fight here at this important zone, this important inflection area, and on a weekly basis, it is managing to close above it or at it once again. We're not quite out of the woods yet. We would want to see some more follow through up next week, but again, when we start to think about, as traders, the some of the washout we just looked at in terms of market internals, we haven't looked at the VIX yet, but some of these other things that are going on, these washout levels happening and holding at this support, this bigger support area, you've got to be at least a little bit kind of open-minded, constructive here on this market. Again, we don't know if the worst of it is over yet, but we do have the clues here that at least the market's putting on a good fight. Heaviest volume week that we've seen going back to July. It's happening on increased volume. Let's see, I think, if the buyers can get some follow through next week. Again, I still hang my hat on this general zone here. We've been trading a lot around it. You could use this week's lows, last week's lows, or you could just say, if it starts trading back below 42.50 or so, I'm out. But you have some clear defined stop area, some clear, risk management controls. I think that's absolutely, super important in this type of market environment right now. But generally speaking here, I am constructive that back-to-back weeks tried to reverse up, closed off of the lows, and we'll see if we can get that follow through. So bottom end of the range, 4 or 5 weeks down. Let's see if the S&P can hold here. If we start rolling over next week, if we start closing definitively below 42.80 or so, then again, all bets are off. I get a little more or a lot more pessimistic on this market. But right now, I think the buyers, the bulls, deserve a little bit of benefit of the doubt. So that's the read there on the S&P 500. Nasdaq 100. Once again, putting on these big levels and cleaning up the noise. Weekly time frame, it's trying to hold in there. And this was the story we had last week, right? We talked about, I think the headline of our video last week was sellers exhaustion. And, you know, we were kind of putting that as a question mark, but we had some signs that the sellers were a bit exhausted here last week. And, you know, lo and behold, we followed it up with, again, some more volatility. We briefly broke and we're trading at multi-month lows here in the Nasdaq 100 this week, but buyers ended up taking control, drove us off the lows. We took out last week's highs, and it looks like we're trying to hold support with a rotation week up. So for me, again, Nasdaq still sporting lots of strength here. Take a look at the XLK, even, you know, kind of always a very similar picture, just a different weighting with some of the big heavyweight components. This actually, you know, looks a little bit better. Big volume week, holding support, rotation up. So I think you're getting some clues here that technology is at least enjoying this or trying to hang in there and rotate up after, you know, 3, 4, 5 weeks down. So that's kind of the read there. Russell 2000, again, still the toughest spot to be undoubtedly. It was down 2% this week, well off of the lows, heavy volume coming in, getting back towards the lower end of this broader range that it's been in since 2022. Still looks like, I mean, just a mess. I mean, quite frankly, there's really no two ways to really dress this up. The best case here is that we are, you know, pretty significantly oversold using various metrics here. So, you know, a rally back up into the 180s or the upper 170s, that's certainly in the cards here. I'd say, you know, we could still just be in a downtrend and get all the way back up to the upper 170s and just kind of work off these extreme oversold conditions. But it is certainly a lot less exciting. I think if, you know, longer term, if you're value hunting with Russell 2000 and you're starting to get down into the 160s here at the lower end of a multi-year range, then you've got some, you know, opportunity to take some shots. But generally speaking, IWM probably has the most to rebound given it was down the hardest. So that's kind of the read there across the major markets. A few other things we want to talk about here in terms of other macro assets. Here is gold. Gold, again, rebounding pretty aggressively here. Well, relatively aggressively, 0.5% up on Friday, but still a nice small win here for the bulls after a very tough kind of 2 weeks of trading. Gold was down about 6% from the middle of September. Heavy volume came in here on the selling. Again, 2 back-to-back heavy volume weekly days. The charts have been kind of reset here, and they look a little bit more messy, unclear. The picture here for GLD bulls, you can see we're back to the February, March lows earlier from the year, and just lots of pain and kind of a broken chart in the short term. So seems like, you know, again, we could get a little bit of a rally up to about 175 in gold and still be in a downtrend on this intermediate term basis. For me, you know, it talked about a trade that we had in gold going back here in August. You know, we were enjoying gold, pulling back to, you know, kind of the June, July lows, trying to hold in here. That was the game plan, scaled some off, and then, you know, sold out at break even on the second half. So that's was a former trade. Once it got back below kind of 175, 176, kind of all bets are off there, and gold's still looking pretty bleak right now, but certainly oversold. Silver, kind of same thing, had that huge move on Friday of last week, big gap up, kind of engulfed down, and then we saw again just a big gap down on Monday, followed by a lot more volatility. So again, just in a really tough technical spot, tough to make too much of an exciting case for either of the metals right now. If we go to yields here, so IEF, so this is the 7 to 10 year treasury bond. And again, you can see on a weekly basis, one of the heaviest volume weeks we've seen in quite some time for IEF treasuries. You can see again, new cycle lows this week. If you flip it out and look at the actual yield index, which we sort of looked at earlier, but you can see again, just new cycle highs in the actual yield itself. And if we go to TLT, take a look at the volume here. So you have pretty much the heaviest volume week. If you're a believer in TC2000's data here, looks like the heaviest volume week ever for TLT, going all the way back to 2002. So it's a pretty long time, couple of decades worth of data here. And this is the heaviest volume that we have ever seen trade, 270 million shares in the TLT. And again, there's lots more proxies for, you know, treasury bonds or that you could use, but TLT probably one of the most you know, liquid and traded. You can see 62 million shares traded on Friday. We kind of gapped down to start the day after jobs data, and then we managed to, you know, close a little bit higher, not quite towards the highs of the day, but certainly as we posed the question earlier this week, or I'm sorry, earlier at the top of the video, is this capitulation? Are we seeing some capitulation here for TLT bondholders? Again, if we go to, say, rolling returns, this is a custom layout we have in TC2000, and we throw on a weekly chart here, you can see just how much pain there is, or even a monthly chart. I mean, take a look at the monthly chart here. Take a look at, some of these monthly rolling returns, and you can see, again, just how deep and widespread this this correction has been. If you're taking it from the highs made back in 2020 for TLT, you have pretty much a 50% or so drawdown. I'm not so sure if that's including dividend yields in that, if that's price adjusted or not, but generally speaking, you're basically cut in half here on your principal. So biggest drawdown we have seen in quite some time. And again, like we said, if you are a fixed income investor, you can get 5% on your money now locked in here. So interesting to see how this follows up, but clearly heavy volume as lots of shares trade hands here. I got no position. I still would say if this is capitulation, sure, you could try and buy the TLT if you're, wild enough and daring enough to buy the blood here, but you might just be best served with Qs, frankly, right? Or with technology, which is going to directly benefit from topping out in yields. I know this is longer term stuff, so it doesn't translate exact, but generally speaking, you might even get more bang for your buck here in technology. So a little bit of a side rant there, but that is an important chart. And VIX, got to talk about VIX here. So you can see again, VIX has been stubbornly in the teens, kind of 15 or below for the past handful of months, oscillating around 15. And of course, this week you saw finally this spike up all the way from sub 13 all the way up to almost 21. It hit on Wednesday afternoon. You can see we definitely closed about 3 or 4 points off of those highs. So we'll see if that was it, if that was fear, if that was kind of the peak in hedging right there, and the market is going to cool off and kind of trend back down towards the 15 area where it likes to hang out. That would be a nice short-term bottom that gets marked, but for equities, but time will tell. So that, I think, is about everything I had for the big stuff. Looking at some notes here. Yeah, we talked about NVIDIA last week about how this failed to break down. We had the recipe for some type of bear flag here in NVIDIA, but it never happened. We just saw kind of a sell-off down to about this 410 level, big important multi-month level, and then the magical bid has appeared and has floated higher. NVIDIA looking pretty good. So certainly, the market has been saved, as they say. So that, I think, is about it for me. Hopefully everybody had a good week out there trading. If we finish off here with our industry top industries, weakest industries here, I'll just leave this screen on. This is a stock scan basically applied to all the sectors and industries, and you can see these are the notable weaker weak names, breaking down mostly oil and energy, and then of course on the upside. Actually, we did not talk about oil. Let's take a quick look at that before we go this afternoon. 8.29% down. So if you look at this weekly chart, you can see we had basically a 37% advance starting in June all the way up to the 83s in the USO ETF. And this week we just gave back a good chunk of that, about 20% of the rally. Heavy volume coming in here. So oil kind of looks interesting. I mean, it's resetting back to this area. I hate the speed at which it's breaking back down, but it seems like if you're believing in this trend and the overall trajectory here of oil is kind of higher for longer, then these are levels where you start to pay back attention to it as it retests the old $72, $73, $74 breakout. So something kind of interesting there, but certainly see how that gets followed up next week. So that is it for me. Leave a comment below. Love to know what you're looking at. What charts are you spending some time on? What do you think? Did this market just bottom out? Are you as optimistic as me, or do you think we just have a temporary kind of bounce here before we roll back over? Leave a comment below. Love to hear it. And as always, I want to thank you for tuning in every Friday. Long form market analysis just like this. Check out the links in the description of this video for IBD and for TradeRisk's TC2000 scans and trading systems. Have a great weekend. We'll see you back here next week.